Can you retire on $1 million? This is how retirees live on $1 million. How long will $1 million last in retirement? $1 million is a lot of money, but is it enough money? What's up everybody, I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. Knowing how much money you need in order to live financially free is one of the most important financial questions you can ask yourself. I got my handy dandy whiteboard because today I want to go over how far $1 million can actually go. How you use your $1 million is going to depend on a couple different things. It's going to depend on how you spend your money, and it's going to depend on how you actually use your $1 million. So let's start by talking about you using your $1 million to live a $1 million lifestyle. If you want to go out and live that $1 million lifestyle, then you're probably going to keep this $1 million in cash in your bank. That way you can access it very easily. And now what you're going to do is you're going to go out and you want to look good on Instagram. So you're going to buy yourself, let's say, a $500,000 house with cash. That way you don't have to deal with any mortgage payments. And then you're going to buy yourself a nice $200,000, maybe an Audi R8, a nice supercar. You're going to go on a few vacations. So there's a plane, looks like a plane. And in a couple of years, you are going to be broke. So if you want to live the Instagram flexing lifestyle, then the $1 million is not going to last you very long. This should be pretty obvious. If you're subscribed to a YouTube channel, you understand that it doesn't really matter how much money you make. It's what you do with the money you make. Even if you have $1 million, you can go broke almost instantly if you don't know how to use your money the right way. And if you're not subscribed to a YouTube channel, you should do that. But this is why so many high-paid athletes and so many high-paid lottery winners end up broke so quickly, is because you make a ton of money, but you don't have any financial education. So what do you do when you make a lot of money? You blow it. Now, when you blow all this money you have a bunch of nice things, but you have no money left. This is the majority mindset way of spending money. You make a ton of money and then you blow it on a bunch of nice things that make you look rich, but they keep you broke. And so this is going to be a big no-no when you make $1 million. Now, don't get me wrong. I want you to own a nice home and I want you to drive a nice car and I want you to go on nice vacations, but I want to make sure you can afford it. That way you have cash to live your life financially free. So let's go into the second way that you can use your money. Now let's assume that you have this $1 million, but you're conservative. You don't like the whole idea of investing your money because you don't want to throw your money in the stock market and see this $1 million get sliced in half if the stock market crashes. So you want to be safe and you just put this money in the bank. This is how I grew up learning about money. I grew up in a traditional Indian house, and Indian people love saving money. It is like in our blood. And so Indian people make $1 to spend 20 cents and save 80 cents. Well, in the American culture, it is very common to make $1 and then spend $1.20 with lines of credit and credit cards and loans. And so Indian people are born with that saving mentality. And so what do? You make money and then you save as much money as possible, and you don't want to invest it because investing is risky. And so you build this huge savings cushion. That way you can live wealthy. Now, saving your money is better than blowing all of your money on nice cars and clothes, but it doesn't give you the full potential of your money because your money is just sitting there flat and is getting eaten away by inflation. I already made a video where I talk about if you can get rich by being cheap. So if you want to learn more about that, I'll link it for you in the description below. In the financial world, there is something called the 4% rule, which says you take your savings and investments and you add it up, and then you live off of 4% of that a year and you adjust it for inflation. So in this example, I'm going to take a modified version of this 4% rule and say that you want to live off of just $40,000 a year, which is 4% of your $1 million you saved up in cash. If you live off of $40,000 a year, then this $1 million is going to last you 25 years because now you're not investing your money. This $1 million is just sitting in your bank account, and every single year you're just gonna draw out $40,000. So January 1st every year you draw out $40,000 and you live off of the $40,000 for 12 months. If you continue to do that, you will be able to live off of your $1 million for 25 years. After 25 years, you're not going to have any more money. I'm assuming for the sake of this example that this $1 million is just sitting in your bank account and it's not growing at all, because right now savings accounts are not paying you anything. So if your $1 million is not growing and you're just pulling out $40,000 a year, then you will be able to live off of this money for 25 years and you will be living a $40,000 a year lifestyle. But this doesn't factor in inflation, because as you know, the value of our money doesn't stay the same. That's why $100 today can't buy as much as $100 could back in 1970, because our money is slowly losing value over time because of inflation. Now, if we factor inflation into this, and now you're not pulling out $40,000 every single year, you pull out $40,000 this year, and then you pull out a little bit more money next year, and then a little bit more money after that by factoring in a 2% inflation rate. Now, you're not gonna have enough money to live off of this $1 million for 25 years. You're gonna have enough money to live off of for 21 years. So if you want to live a $40,000 lifestyle, then you can expect this money to last you for 21 to 25 years, depending on what inflation is, if you have $1 million. Now, if you want to live a $100,000 a year lifestyle, you can just adjust the numbers. So if your goal is just to save your money that you can draw cash out of, well, now you can do the math to see how long this money is going to actually last you. Now, this time, instead of saving your cash, let's say you have the minority mindset where you invest your cash and you want passive income. So you invest your money in the stock market for dividends. And I'm going to give you two different scenarios. Scenario one, you invest it in McDonald's, MCD, or you invest it in IBM. So scenario one, you invest all $1 million into McDonald's, and scenario two, you invest all $1 million into IBM. Now, look, I am just a random guy on YouTube, okay? So don't blindly listen to anything I say, and make sure you do your own research. I do not recommend that you take all of your cash and throw it into one stock just because of the dividend. This is just a hypothetical. Some companies in the stock market, like McDonald's and IBM at the time when we were recording this video, make a lot of money. And at the end of the year, they have a whole bunch of cash in their bank account, and they just don't know how to invest all this money back into their business. And so what they do is they take this cash and they just give it away to their investors, people like you who invest in their stock. So if you go out and you invest in one share of McDonald's or one share of IBM, then you will get these passive income checks called dividends deposited directly into your account. At the time of me recording this video, McDonald's pays a 2.5% dividend, which means if you invest $1 million into the McDonald's stock, you will make $25,000 a year from your McDonald's investment. IBM, on the other hand, pays out around a 5% dividend yield right now, which means if you invest $1 million into IBM, you will make $50,000 a year in passive income from dividends. So you still own your investment, but every year you're getting a check from McDonald's or from IBM for doing nothing except just owning their stock. So you don't have to sell your stock to get these dividend checks. You just own the stock, and then every 3 months, every quarter, you are going to get a check from McDonald's or IBM. Before you go out and you start living this $50,000 or $25,000 a year lifestyle from your passive income, remember, the government wants their cut, so you gotta pay taxes. Luckily, dividend income has a lower tax rate because the government wants to incentivize you to invest your money and get this type of passive income, so they reward you with lower taxes. If you make between $0 and $40,000 a year in taxable income at the time of recording this video, you have to pay 0% of your money in taxes. If you make between $40,000 and $441,000 a year in taxable income, then on your dividends, you have to pay 15% in taxes. And if you make more than $441,000 a year, then you are paying 20% a year in taxes on your dividends. At this point, you might be thinking, why in the world would anybody want to invest in McDonald's where you can only make a 2.5% dividend when you can invest in IBM and make a 5% annual dividend? Well, there's a little bit more to what meets the eye. Over the last 2 decades or so, the price of IBM stock has stayed pretty much flat, and over the last decade, the last 10 years, IBM stock has actually come down about 10%. So if you invested this $1 million into IBM, it hasn't really gone anywhere, and if anything, if you invested over the last decade, it has come down, even though you're making more money in dividends here. With McDonald's, on the other hand, the price of their stock has gone up 5-fold over the last couple decades, and over the last decade, the price of the stock has doubled. So if you invested this $1 million into McDonald's a decade ago, this would be worth about $2 million, and if you invested into them 5 years ago, this would be worth about $5 million, even though your dividends aren't as big. So you have to understand there's a little bit more to what meets the eye, because there's more to investing than just the dividend price, which is why you do not want to make your investment decisions based solely on this dividend percentage. You want to look at the underlying fundamentals of the company, and you want to make sure you're investing in a company that's growing, that you believe in for the future, because if you do that, then you're going to make a whole lot more money than just this dividend price. Now, past performance does not predict the future performance in any way, but but I just want you to understand this because if you invested $1 million here versus $1 million here, then you are going to make less money in passive income for a little while here, but you could also pull some of your stock out and sell some of your stock and have some cash and still see the stock growth and still see the value of your $1 million grow while having more cash in your hand. In any case, with both of these examples, you have income that you can use to live off of every single year, and you also still have this $1 million nest egg. Now, if the price of the stock goes down, the value of your investment will go down too, but in general, you still have a big chunk of your investment just sitting there invested in one of these companies, and you also have passive income that you can live off of without selling any of your investment. The third thing that you can do with this money is you say, you know what, I don't want to invest my money for dividends. I want to invest my money in the stock market to see my money grow, but I don't know which stock to put my company in, so I'm just going to put my money in the stock market, and if the stock market goes up, my $1 million will go up, and if the stock market goes down, well, I will take that risk. And now what you're planning on doing is taking out a little bit of your profits every single year, or taking out a little bit of your equity rather every single year. And if you have profits, then that's just icing on the top. Now, instead of just keeping your money in cash in the bank, you're putting your money to work by putting it into something like VOO or SPY. These are two funds that give you exposure to the broader stock market. VOO and SPY both give you exposure to the top 500 companies in the stock market. So now if the stock market goes up, your fund will go up, and if the stock market goes down, your fund generally goes down. You can draw cash out just like you could in the bank, but now you have a little bit more risk because if the stock market goes down, the value of your $1 million will go down too. To put some numbers on this for context, in December of 2010, VOO was trading for around $110 a share, and SPY was trading for around $125 a share. Then in December 2020, 1 decade later, VOO went from $100 a share to around $340 a share, and SPY went up to $375 a share. So both of these funds saw right around a 300% increase over 1 decade between December 2010 and December 2020. What this tells us is if you put $1 million here or here in December 2010, you would have something around $3 million over here. But the issue with that is then you don't have any money to live off of for this decade. So if you live off of 6% of your income now, so meaning in 2010, you take $60,000 out. So now you have $940,000 to invest, and you put it here or here, you would still see a profitable growth. That means now you're not taking out 4% like I talked about before, you're taking out $60,000 or 6% of whatever your pool is every single year, and you're still seeing a profitable growth because you're seeing more than a 10% growth on your money year after year after year. So you're pulling out 6%, but your money is growing by 10%, so although you're taking out more money than before, your money is still growing faster than what you're pulling out. In this situation, you have a couple benefits. You get to pull out more cash than you did before, so you can live a bigger lifestyle, and you still have your nest egg, and your nest egg is growing on top of that. Before, when you just saved $1 million, every time you pulled money out, your nest egg grew smaller, so you had less and less cash available. Now you're pulling more money out, but your nest egg keeps growing bigger. Now I know you're probably thinking, but just because the stock market went up in the past doesn't mean it's going to continue to go up at the same rate in the future. You're 100% right. Maybe the stock market will go down. Maybe it will stay flat. Maybe it will go up faster than this. Maybe it'll go up slower than this. There's no way to predict that, but this is the risk you take from you investing your money. And that's also why more risk comes with more potential reward. Now, I should also mention that when you pull out cash in this situation, when you sell your stock and you have a profit, you have to pay taxes on your profits. That doesn't mean you pay taxes on every dollar you pull out, because some of this money, this $1 million, is yours. So when you pull this $1 million out, you don't pay any taxes. There's lower tax rates that I talked about earlier. If you don't like the idea of owning these paper investments like stocks, and you want to own a tangible physical investment that you can see that will pay you passive income, then you can look into investing in real estate. So real estate is my favorite investment class just because I like the idea of creating passive income through owning a physical asset. I'm trying to draw an apartment complex here, so bear with me. I hope that looks like an apartment. But when you buy an investment like real estate, now you own something physical that you can see, feel, and touch, like this property. And now what your goal is to own this property and put tenants, people into this property who are going to live there or use your property, and in exchange for them using your property, they're going to pay you rent every single month. So you don't have to do any physical work to earn this income, because once you own the asset, you can hire a management company or a property manager to do all the physical day-to-day work, but you will get this passive income every single month because people are living in or using your property, and for them to do that, they have to pay you rent. When I invest in real estate, my goal is to get a minimum 7% annual return on my money. So if you invest $1 million into a property, let's say you buy a small apartment complex, then my goal would be to make $70,000 a year in passive income profits after paying all your expenses from owning this property. So after paying all your expenses, you should be left with $70,000 in your bank account. At first glance, you're making the most money here, but don't forget about taxes, because you got to pay taxes on your income. Now, as an attorney, I can tell you that real estate has a bunch of legal tax loopholes that you can use. Now, although I am an attorney, I am not your attorney, so if you have specific tax questions, make sure you talk to a tax specialist in your area. Now, what you can do with real estate here is you could tell the government, hey, yeah, I made $70,000, but I don't want to pay taxes on all $70,000 because my property is a year older. And so what you get to do if you have $1 million property is you get to take a $25,000 deduction every single year for the next 30 or so years, because the property that you own is just 1 year older. And so you get to tell the government, I'm only going to pay taxes on $45,000, even though I made $70,000, because you get to take this deduction called the depreciation deduction every single year for just under 30 years because you are investing in real estate. And that's just one of the loopholes you get for investing in real estate. So if we calculate this out, if you tell the IRS that you made $45,000 in income from your real estate property, you're going to have to pay around $5,000 in taxes, because you don't have to pay Social Security taxes or Medicare taxes. You only have to pay your income taxes, which means you are going to be left with right around $65,000. You made $70,000, you only pay taxes on $45,000, and you will be left with about $65,000 that you can use to live your life, and you still own this $1 million property. Now, there are some other legal loopholes that you can use in real estate to lower your taxable income even lower, but I'm not going to go over all of that in this video. Hopefully, you'll see your property value go up, which will add some icing on top of this passive income. But when I analyze my real estate investment deals, I'm looking at this, the passive income. I'm not looking at what potential value this could go up to, because I just want to see how much money I can make every single month. As a quick little tip on this, real estate does have more risk, because now you have to physically manage this property and deal with tenants and work with property managers and work with real estate agents and work with contractors. So there's more upfront work required, and there's more of kind of like a skill set required, because now you're not just investing in a company like McDonald's and IBM and letting them handle the investment. You are the one managing your investment here. So now if we really analyze how far $1 million can take you, it depends on how you use your cash. If you just save the $1 million, that means you will be able to live off of, let's say, $40,000 a year, and you have 21 to 25 years of money. After the 21 to 25 years, your money is gone and you have no money left. If you invest this money into dividend-paying stocks like the McDonald's or IBM that we discussed, then you can expect to make somewhere between $25,000 and $50,000 a year to live off of, based on today's numbers. And this will last you as long as the company is strong, because now you're owning an investment that will continue to pay you dividends as long as the economy is strong and as long as the company that you're investing in is making money. If you invested this money into an index like VOO or SPY that gives you exposure to the general stock market, then we're talking about something like $60,000 a year based off of the historical numbers that we saw. And again, how long will this last? Well, as long as the economy is growing and the stock market is growing. These come with more risk than this, but there's more potential to make more money. And if you invest this money into real estate, then hopefully, depending on where you live, you should be able to make about $70,000 a year in passive income. Again, these are all pre-tax numbers. And how long will this last you? Well, it depends on how good the area is that you invest in. If the location continues to thrive, then you will be able to make money from that property for generations. But if the area that you're investing in starts to tank and people move away, then you might not continue to see the same rental income that you're seeing right now. If you enjoyed this video, here's a video that I think you'll love. And while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making? How are their profits looking? Are their revenues growing? Are their profits growing? How is the management, and are they innovating for the future? So these are the things that really affect a company's stock price over the long term.